Demand for PGMs is not likely to fall off a cliff, but it's more likely to slow at a more stable rate or at a much slower pace, especially for palladium. Whereas for platinum, if the hydrogen economy takes off, we could actually see demand starting to grow. There are some estimates that have the hydrogen economy adding platinum demand in excess of 1 million ounces by the time we get to 2027, 2028. So we could see a huge swing in the market balances, which makes it more difficult for producers to plan. And we haven't necessarily seen the capital investment that's required just yet, given that it may take 8 to 10 years for some of the supply to come online. Firstly, thank you to One-to-One Mining and Adam for having me here. It's a great opportunity to be able to share our views with you. So starting off with the outlook for the precious metals, we can see over the past 20 years or so, we've had the most amount of volatility in the past 2 to 3 years. So to say that the PGM markets are choppy is something of an understatement. The trading range that we have seen in markets like rhodium have set highs that we haven't actually seen until last year. So the trading range in rhodium last year was over $18,000 per ounce, and we didn't see levels in the market being traded at that point until 2020. And similarly in palladium, we see a very similar outlook as well. Last year, we had a trading range of over $1,000 per ounce, and that was around about 1,600, and we didn't see highs of 1,600 in the palladium market until 2019. So it's been quite a range. Ordinarily, we tend to see supply and demand dynamics are the key factors within the PGM market, in contrast to the broader precious metals complex, where within gold and silver, we tend to see investor interest is much more dominant. But in particular, this year, I think we're starting to see that supply and demand dynamics are even more crucial. Zooming in a little bit over the past 2 to 3 years, we can see that since the start of 2020, prices are now trading at levels before the pandemic. And here it's really been driven by a number of factors that at the start of the year have been defied. So if we go back to 2020, this was a year where we thought we were going to see an eventual recovery, we were going to see a pickup in demand, and that didn't happen at all. With COVID, we saw prices coming off quite sharply, and in platinum in particular, we saw lows that we hadn't seen in the market in over 20 years. But having said that, prices are now trading at levels since the pandemic, and rhodium in particular is the market where we've seen huge amounts of volatility. But this has really masked some of the underlying dynamics. So just looking at the price action now, we could perhaps expect more upside risk, but we think there are a number of downside risks that are being masked by the momentum that we've seen across the complex. The price action itself also suggests that we have markets that are quite tight, with prices remaining elevated compared to their historical levels. But if we dig a little bit deeper and look at, for instance, the forward curve or lease rates, we see a slightly different market dynamic. So for instance, the forward curve, which is a curve that is normally in contango, given the spot price plus the cost to carry, should normally be upward sloping. But in palladium, we have a market that is mostly flat, which indicates limited risk in the near term. But for the platinum market, we have a backwardated curve. And this suggests that we have market tightness at the moment, but that tightness is likely to ease in the next year or so. In contrast, the lease rates actually suggest that the palladium market is quite well supplied. And in contrast, we're seeing a platinum market where lease rates are starting to tick higher. So this really conflicts with some of the dynamics that we see in terms of the price action and also in terms of the market balances. For platinum in particular, we see market balances that suggest that the market will be very well supplied in 2022 and in 2023. But the forward curve and lease rates suggest that we have very tight physical markets. So it's important to look at where price action is, where the forward curve is, where lease rates are, and the market balance, the supply and demand dynamics, to be able to really grasp how tight these markets are and where the price risks lie for each of them. So looking at the balance for each of the PGMs, we see that we have a platinum market that was oversupplied last year in excess of 1 million ounces. And this year we expect that market surplus to drop a little bit, but we are still expecting a very well supplied market for platinum. In contrast, for palladium, we've had markets that have been vastly undersupplied over the past 5 or 6 years, and that market is now switching from a deficit to mostly a balanced market. And rhodium is very similar. It's a market that we've seen broadly in deficit or balanced, and that's now starting to switch to a more balanced market that could easily swing in both directions. Now, I know you would say that each of these markets could in any year be in a deficit or a surplus. But in this year in particular, the platinum market looks like it will remain well supplied, despite the indications that we're seeing in the lease rates and the forward curves. But the palladium market and the rhodium market are very close to balance. So we're expecting the rhodium market to deliver a very small surplus of 12,000 ounces, and the palladium market to deliver a very small surplus of 34,000 ounces. So these markets are very evenly matched, and a small unexpected disruption or an oversupply from any of the producers could easily see these markets tilt in either direction. But this sets the tone for the year as a whole, but on a quarter-by-quarter basis, there are different dynamics that are at play. And we've seen this play out over the past few years. So for instance, in 2020, this was a year where we thought we were starting to see the demand side recovering. But instead, the market, when we had COVID being factored in, demand projections were being scaled back across the spectrum. And instead, we saw supply being curtailed instead. And that supply tightness and the slower recovery in demand meant that we saw quite a sharp recovery from the lows that we saw from the COVID. Initially, when COVID was declared a global pandemic in March 2020. So we saw a very slow recovery. In 2021, once again, we had markets where the market was looking for a demand recovery. Economies around the world were starting to reopen. We were starting to see travel resume. But instead, we had the flooding at Norilsk Nickel. Now, Norilsk Nickel Nornickel, I should say, is the world's largest palladium producer, accounting for almost 40% of the world's palladium. So we saw this market swing from focusing on demand and instead focusing on supply losses. The market had started to talk about potential chip shortages, but no one had really factored them into their balances in the first half of the year. And in fact, the recovery from the supply losses that we saw with the flooding and the concentrator outages in Russia didn't really impact the market balance in the second half of the year. It was very much a Q2 dynamic. And instead, the chip shortages, which were expected to be resolved in the middle of 2021, dragged on through the remainder of the year. So we had a market that was initially focused on supply losses, swinging very quickly to what we would see become demand losses. And we think this year we could actually see a very similar dynamic play out. Initially, we have a market that was concerned about supply losses over Russia's invasion of Ukraine, and we can now see that swinging to what may be more demand losses or demand losses offsetting any supply losses that may materialize. So overall, we have 3 different factors that we think are crucial to watch for this year. The first is Russia's invasion of Ukraine and the implications for both the supply side and the demand side. The second is the chip shortages and the losses we may see in terms of slower economic growth or potentially slower economic growth and the risk of recession, impacting not just the auto market, but also industrial end usages. And then thirdly, the macro environment. We are expecting the Fed to tighten at its fastest pace with increases of 50 basis points at the next FOMC meeting. And the market hasn't really digested such rapid hikes in a number of years. So if we go back to the 1980 hiking cycle, that's really when we last saw the markets having to digest inflation at elevated levels where we have it at the moment, but also rate hikes at a much faster pace as well. So we think a combination of a monetary policy which had been incredibly loose, now starting to tighten, the implications of China's lockdown measures impacting the demand side are going to have quite a significant impact on the platinum group metals. So overall, we see these 3 dynamics as the key ones to watch for 2022. Starting with Russia's invasion of Ukraine, initially the market was very much focused on what the supply losses would be. This is natural given that Russia produces around about 40% of the world's palladium, accounts for around about 12% of the world's platinum and around about 9% of the world's rhodium. The markets were concerned that we may see disruptions in terms of trade flow, and yes, there were airspace closures. But none of the commodities in terms of PGMs have been sanctioned, and none of the producers have been sanctioned. The London platinum palladium market did suspend the two largest refiners from Russia on 8th of April, and we saw the UK increasing its tariff for PGM shipments from Russia by 35% last month as well. So yes, we have some restrictions that are in place, but we haven't actually seen actual supply disruptions materializing just yet. So Russia, in particular, its output could swing in both directions. So on the one hand, you could argue that with more difficulties around shipments, logistical delays, we may see less metal coming out of Russia. And also with some end equipment manufacturers less willing to ship supplies to Russia, there could be a drop in what their production may be this year, or certainly what their output might look like over the next 2 to 3 years, given that Nornickel has its South Cluster expansion project as well, which should start to come online next year and in 2024. But equally, we could say that because the companies haven't been sanctioned, because palladium itself has not been sanctioned, that supply should materialize. So yes, the supply could swing in both directions. We have taken the view that we will see a modest increase in Russia's output. We have a low base in 2021, given the flooding and the concentrator outage that we saw from Nornickel. So we think that production will be slightly higher than last year, but perhaps not on track to the levels that we expected at the start of this year. So overall, yes, initially the markets were concerned that Russia would present a huge supply risk. But in terms of the data that we've had so far, that doesn't look like it's necessarily going to be the case. So the data that we do have so far, we could look at where Russia normally ships to. And historically, we've seen that the three key regions are really Japan, Europe, and North America. In fact, North America and Europe normally account for 2/3 of the supply that comes from Russia. But if we look at the market in a slightly different way, and theoretically, we could say that Russia produces less than what China consumes. So theoretically, you could see the 2.7 million ounces that Russia produced last year could be easily satisfied by China's consumption, whereby last year they consumed 3 million ounces. In fact, if we look at the entire PGM market, if we look at platinum, palladium, and rhodium, China has been consuming more than what Russia produces since 2012. And if you go back to 2019, at this point we started seeing China consuming more than what Russia produced in terms of platinum and palladium combined. So theoretically, you could see Russia's supply ending up in China or other regions where sanctions do not apply. And Europe and US could source their needs from, say, South Africa, from Zimbabwe, from North America. So theoretically, the markets could be rebalanced, but there are contracts that need to be negotiated. There could be discounts or premiums that are applied. But PGM markets and markets broadly are inherently efficient, so we haven't necessarily seen the supply disruption keeping prices at elevated levels for a prolonged period. The latest data that we really have runs till March. We're starting to get some of the April data coming through, but we can already see some shifts in consumer appetites and producer trends starting to come through. In particular, South Africa is perhaps the biggest swing factor here. We saw over the course of H2 last year and in the early part of this year that shipments from South Africa rose quite significantly as work in progress inventory was released. But if we look at the shipments just in March alone, the amount of PGMs that were shipped from South Africa were higher than their 5-year average. And in fact, the amount of PGMs that were shipped to the US in March was higher than its 5-year average that we typically tend to see in March as well. So we were starting to see some of these trends starting to move. Historically, we've seen the US taking around about 40% of its palladium needs from Russia. So it's early days. The April data shows a little bit of a change when we look at the shipment data from China. We saw an increase in platinum demand, and that was largely being driven by low platinum prices, stimulating some of that interest in perhaps strategic buying. So where we've seen the real impact from Russia's invasion of Ukraine hasn't necessarily been on the supply side. We could have potentially have seen losses of 2 million ounces of palladium. That's what would have been at risk. Around about 600,000 of platinum would have been at risk. Around 60,000 ounces of rhodium would have been at risk. Instead, we're starting to see a more material impact when it comes to the demand side. Partially, this has been driven by auto revision forecasts in terms of global production forecasts. The losses in terms of Russia's auto production, it's only around about 1.5 million units, so not substantial. But the losses that can materialize because of the supply disruptions around wiring harnesses or the supply of neon gas, which primarily comes from the Ukraine, could have a much larger impact when it comes to semiconductor shipments. So previously, before we started to see the auto production forecasts being revised down by major auto data providers, we had estimated that we could potentially see losses of palladium of around about 375 ounces. Losses of platinum could be around about 100,000 ounces for the whole of this year. Instead, when we look at the data or the forecasts that we already have for April, we can see that our expected losses for this year on the demand side are already greater than our initial estimates. So for palladium, we're potentially looking at losses of around about 500,000 ounces. And for platinum, we're potentially looking at losses of around about 300,000 ounces. So the revisions that we could expect to see on the demand side are much greater. If we look at the key importers of Russian metal, we can see that historically the US has taken around about 40% of its metal from Russia. China's taken around about 29% of its metal from Russia, at least in 2021. But Hong Kong took about 70% of its platinum needs from Russia last year. So yes, we can see that there are potential risks, but more so the risks are from where US will get its PGM needs met. But we could see that the demand side losses are going to be much greater at this stage. So looking at where potential supply could be fulfilled, if we start to see countries across Europe and across North America looking to meet their needs elsewhere, we can't necessarily assume that we'll see an increase in supply from, say, countries like South Africa. We know that South Africa supplies the world around about 70% or just over 70% of its platinum, just over a third of palladium, and over 80% of the world's rhodium comes from South Africa. And on the surface, we could say that we've saw an increase in shipments from South Africa over the past 6 to 9 months. So perhaps demand needs could be met outside of Russia. So theoretically, this looks like it could be the case, especially if you look at the PGM basket. It's benefited from elevated or record high rhodium prices, record high palladium prices, and platinum prices remaining relatively stable. So even if you look across the curve, even the most expensive producers have been profitable over the past couple of years. We've seen wider cash margins. But now we've had the wage negotiations which have started to take place in South Africa, and there are inflation risks, so we could start to see some of these cash margins starting to erode, but we do expect PGM prices to remain elevated. So despite the elevated PGM basket price, we don't expect a substantial amount of growth from South African output this year. In fact, we've seen the major South African producers scaling back their production targets for 2022. This year, we've had the South African producers say that on the back of numerous reasons, from COVID-related stoppages, safety-related stoppages, or load shedding, that they've had to revise down their production targets. And we can't necessarily expect an increase in shipments from work in progress inventory either. We had the Anglo concentrator plant outage back in 2020, so there had been a build in inventory, and that had been planned to be released through 2021 and 2022. but the bulk of those shipments have already been released into the market. So there's less of a buffer from that excess build that could satisfy any increase in demand that we may hope to see in the second half of the year. So overall, with South African production, we expect to start to trend lower this year, but we're not expecting a substantial boost in South African output over the next 10 years either. So we do think that production will start to stabilize, but not necessarily a huge increase. So on the supply side, we think that the forecasts that we had at the start of the year were quite optimistic. We've actually revised down our global supply for palladium from South Africa by 300,000 ounces and for platinum by 300,000 ounces and for palladium 100,000 ounces. So we're seeing contractions both on the demand side and on the supply side. But the revisions that we've had on the demand side have actually been greater. So we think auto market weakness is the key swing factor that could potentially materialize in the second half of the year. Now, the auto market was meant to be an area of growth that was meant to materialize in 2021. But instead, we saw the impact of the chip shortages taking many of the forecasts across the street lower. So last year, we didn't actually see the uptick in demands from the auto sector that we were expecting to see. And in fact, this year, we were hoping to see something of an increase as well. We had our forecast at the start of the year of around 10 to 11% in terms of global auto production growth on a global basis for 2022, and a very similar number for 2023 as well. We were looking for an increase of around about 10% next year. We've now scaled back that forecast to around about 7 to 8% for this year, and we think that next year we may get up to about 9 to 10% in terms of an auto recovery. So in terms of PGM demand, the key swing factor at the moment is really the volumes in terms of auto production. Ordinarily, the factors that would be behind the PGM demand growth would be a combination of PGM loadings and auto production. But we expect PGM loadings to remain largely stable, or I should say elevated at their 3-year levels over the course of 2022 and into 2023 as well. We're seeing some thrifting in China. China had been working on a slightly older engine platform compared to the rest of the world, so their PGM loadings had been slightly higher than what we would have seen across the US and across Europe. But they're now starting to thrift some of those loadings, so the average loadings in China should start to fall. Whereas in Europe, across North America, we're starting to see somewhat of an increase in the average loadings across platinum, palladium, and rhodium, just to be able to meet those those tighter emission standards. So PGM loadings are remaining elevated at the sort of average levels that we've seen over the past 3 years, but auto production numbers have taken a little bit longer to recover. So our forecast for autocatalyst demand has been revised down compared to where we had it at the start of the year. We now expect autocatalyst demand to be 500,000 ounces lower than what we had initially expected. But the real turning point where we could see the auto market recovering is really being driven by chip shortages. We hear of producers having cars that are almost complete but waiting in storage to have some final elements fitted, and they're dependent on when they can get some of the parts being supplied again, some of those chip issues being resolved. There's consumer demand. We can see this in elevated used car prices. Consumers do want to replace their vehicles, but they're not being able to get hold of models that they would like, or there's long lead times, and even being able to order the cars that they would like to. So the underlying appetite is there. But in terms of when we expect that turning point, we had initially thought that we'd start to see some of the easing in the bottlenecks at the midpoint of this year, so around about now, June, July. Instead, we've pushed that estimate out to the end of this year. And we think it could actually be at risk of being pushed out into next year as well. So this is, we'd say, perhaps the key risk for the PGM market. It really comes from the auto side rather than the supply side. The supply side, in comparison, even though there are some risks, looks relatively stable. Whereas in terms of the auto production, we're really dependent on the turning point in some of those bottlenecks materializing. And we've had some companies, some chip producers saying that They don't even see a resolution until 2023, and some have pushed out that estimate through to 2024. So the recovery in terms of PGM auto demand could take a lot longer than what we had initially factored in. And then in contrast, we're seeing metals like platinum still doing quite well in terms of its demand and in terms of the buying appetite that we see from countries like China. There are a few underlying themes that are at play here. Partially, there's an expectation that we'll start to see higher platinum loadings eventually materializing. So with palladium prices trading at a significant premium to platinum for such a prolonged period, many OEMs have been looking to switch or utilize or optimize their PGM loadings between platinum, palladium and rhodium for the past 2 to 3 years. And we're now starting to see some of those trends come to light, and we're starting to see some substitution between platinum and palladium. It's been very modest to date. Last year we estimate it was around about 150,000 ounces, and this year we think it could be closer to 250,000 ounces. But some estimates think that this substitution could accelerate to over 1 million ounces by the time we get to 2025. So that could be quite a significant swing in balances between palladium and platinum. In China in particular, we've seen demand for platinum far outpacing what the consumption numbers indicate. So platinum imports for last year, for instance, were around about 3.6 million ounces, but China only consumed 2 million ounces. So there's a huge gap there between what's being actually consumed and what's being imported. Part of this could be driven by the expectation that substitution will eventually take place and there'll be a greater need for platinum. Platinum prices had, in 2020, dipped to the lowest levels since in 2 decades. So lower prices would have been viewed as a buying opportunity, but a combination between strategic buying at low levels and the eventual view that we will start to see some substitution accelerating in the next 2 to 3 years have led to an increase in platinum buying. So this could in part explain why we're seeing such tight indicators when we look at the lease markets, when we look at the forward curves, but when we look at the market balance, which looks at actual consumption and not trade data, why we see huge surpluses at the moment for the platinum market. So as we've talked about, the turning point for the auto market really is dependent on chip shortages. We've seen a number of producers talking about the fact that the more electrification we see in terms of hybrid vehicles or in just in internal combustion engines, the more chips that are needed. In fact, we've seen a shift in powertrains as well. The amount of battery electric vehicles being bought over the past 2 years have tripled to over 6% of the market share. And we've also seen the number of chips that have been used in the market between 2017 and 2021 has also doubled as well. So the electrification, or just not even just the uptake of battery electric vehicles, but just the electrification of vehicles has led to a significant increase in demand in terms of chips. For China and for Europe and for the US, we have downgraded our auto production forecasts. For China, we think we'll see a modest increase of around about 2% now for the full year. We've only just started to get the data through for April to see what the impact will be in terms of auto production losses. And the data that we have had at the moment suggests that there's quite a steep loss of 30 to 40% in underlying demand already in April. In the EU, we've also seen a significant downgrades in terms of auto production, and this has largely been driven by Russia's invasion of Ukraine, exacerbating some of those supply chain shortages, whether we're looking at neon gas supply or wiring harnesses. That's had a knock-on impact in terms of auto production as well. But the used car market has been incredibly strong, especially in the US. We've seen record prices for second-hand vehicles. So partially, this is a reflection of the tightness that we're seeing in the new market, new auto production market, but also the fact that we're not seeing the same amount of supply coming from the recycling of autos or spent autocatalysts either. So the average ownership of vehicles across the US, across Europe, is expanding. So the increase in supply that we may have expected to see from spent autocats hasn't actually materialized. So the recycling supply, or the secondary supply market, has seen limited growth as well. In terms of the auto recovery, we think it will happen. It will just take some time. So in terms of our balances, we're just expecting that recovery to be delayed, but certainly not suspended. Overall, in terms of the demand picture, we think that for platinum, despite the lower projections on the auto side, the scope for substitution, which we're starting to see now on the underfloor catalysts and has been developed now for closed coupled catalysts, where the catalyst is slightly warmer, or slightly hotter, I should say. So thrifting or shifting between platinum and palladium is a little bit more technically challenging, has started to take place as well. But also there's a view that with Russia's invasion of Ukraine, there's been more concern around supply of palladium, and that may speed up some of the substitution that we're seeing between platinum and palladium that had already been in motion over the last couple of years. We haven't factored that into our balances just yet, but we do think that's a risk where we could see more platinum upside risk, certainly in 2023. So overall for this year, we have the demand picture mostly stabilizing. For the auto market, we think that the auto catalyst demand should have risen sharply, and it'll be more of a modest increase now. It's really on the chemical side and the glass production where we may see some more volatility in recovery, and especially if we see slower economic growth. But the big swing factor has really come on the investment side, especially for platinum. So overall, we have markets that we think are very much being driven by supply shocks and by demand shocks. And we're seeing reduced investor interest across the platinum group metals at the moment. We think that the physically backed ETFs are key to track because they are backed by allocated metal. For the palladium market, we've seen huge net redemptions that have materialized since 2016. Over 2.5 million ounces have been redeemed. And this metal has been crucial in terms of the supply and demand balance for palladium. We've seen markets that have been undersupplied, so industrial users have been able to source metal from the ETFs, and elevated prices have meant that some of these investors have wanted to take profits and close out some of those positions. So now we're starting to see the palladium ETFs stabilizing, although they're down just over 40,000 ounces for 2022 so far. So it hasn't been, so I'd say for the palladium market, the palladium ETFs have been a crucial source of supply in order to plug the gap. But for the platinum market, we've seen quite choppy movements in both directions, and we've seen a strength in platinum ETF buying mop up some of the excess supply, but we've also seen it exacerbate supply as well. And so far this year, platinum ETFs are down over 200,000 ounces. For much of last year and the early part of 2021, many investors were excited by the platinum story on a longer term basis, and we saw a huge increase in platinum ETF buying. But a lot of the exciting trends for the platinum market are not likely to play out in the next 2 to 3 years. They are stories that are likely to play out in the next 5 to 10 years. So perhaps taking a position just now was viewed as being premature. And we've seen a very similar trend in terms of tactical positioning in the PGM space as well. Both markets are in net short territory. That means that investors have taken a less positive view on the platinum group metals in the short term. And I think this has largely been driven by risks to the demand side. And as I've shown in terms of our revision, we haven't seen as large downward revisions in terms of platinum, palladium, rhodium supply, but we've seen much larger revisions in terms of the demand side. And this has led many investors to either maintain a net short position in platinum and palladium, or we saw at the start of this year when we saw Russia initially invade Ukraine, some of those short positions were being recovered or being covered, but we didn't see a huge amount of investors coming in to establish long positions in the platinum group metals. So overall, we have markets for platinum, palladium and rhodium that are really being driven by their underlying changes in terms of the supply picture and the demand picture, rather than investors driving the upside or downside risk. The investor interest in the PGMs helps to add to liquidity, so we tend to see less choppy movements when there's more investor interest in the platinum group metals. So I think in the absence of that demand, it's meant that we've seen much sharper moves to both the upside and the demand side for the complex as a whole. And we tend to see the most volatility perhaps in rhodium, where we don't see a readily accessible market for the investor side. So for the palladium market, we have a slightly smaller surplus for this year. For last year, we initially thought we would have a deficit, but now we're seeing this market is becoming largely balanced. We think that next year we're more likely to see the market swinging back into a deficit if we see that auto recovery start to take place. But on a longer term basis, and here we're looking out to say 2025, 2026, we were expecting the palladium market to swing into a surplus on the back of internal combustion engines taking a smaller market share, but also on the back of substitution risk between platinum and palladium. We think that the palladium market is eventually going to become oversupplied on a sustained basis. But with Russia's invasion of Ukraine, we could see some of those trends being accelerated, and we could see the palladium market moving into a surplus perhaps a little bit earlier. The key swing factor to watch is if we don't see the development of, say, the South Cluster materializing, which was meant to add to supply in 2023. That was another factor that was going to add to the surplus materializing in 2025. But if we don't see that supply, then perhaps the surplus will be more likely to materialize in 2024. For the platinum market, we still expect a market that is oversupplied. We think that the platinum market has a very strong story longer term. We think a large part of this is being driven by the changes in terms of powertrains, the scope for substitution. So we do think that the platinum balance is likely to become, or the platinum supply and demand dynamics are likely to become more balanced by the time we get to 2025. But for now, this is a very well supplied market. So despite the tightness that we're seeing in the physical market in the near term, we think that we're ultimately going to see a market that is still well supplied through 2022 and into 2023. But it could swing to a deficit sooner than we had expected. So we'd expected platinum to reach a deficit in 2026, but that could happen a little earlier if we see the expectations around substitution risk being accelerated. We've seen some industry expectations move up their substitution between platinum and palladium for 2025 by 500,000 ounces, so that would very quickly swing the market balance. The rhodium market is in a very similar trend to what we see in palladium. It's a market that was oversupplied last year, a much smaller surplus for this year, but at 12,000 ounces, it's a market that could very easily swing in both directions. Rhodium is very heavily concentrated. Over 80% of its supply comes from South Africa. Over 80% of its demand is driven by the autocatalyst market. So even small changes in either of these two dynamics could see price volatility remaining. And we do expect the PGM complex as a whole to remain volatile. So some of those longer term trends that we expect to materialize are really around the hydrogen economy, around substitution risk, also around the fact that we think that supply might struggle to keep pace with demand. It's very difficult to producers to plan for the next 8 to 10 years when we don't have a clear picture just yet in terms of what powertrains may dominate. Yes, we think that battery electric vehicles will take a greater market share, but we also think internal combustion engines will still exist in some form, but perhaps hybrids will take a greater market share. So one of the running themes at the moment is that we'll see this huge shift in dynamics, and battery electric vehicles will gain a greater market share and PGM demand will decline. However, in our view, we think it's more likely that we're going to see internal combustion engines remaining in the market for slightly longer than what the market expects at the moment, and hybrids are likely to take a larger market share. So the demand for PGMs is not likely to fall off a cliff, but it's more likely to slow at a more stable rate or at a much slower pace, especially for palladium. Whereas for platinum, if the hydrogen economy takes off, we could actually see demand starting to grow. There are some estimates that have the hydrogen economy adding platinum demand in excess of 1 million ounces by the time we get to 2027, 2028. So we could see a huge swing in the market balances, which makes it more difficult for producers to plan. And we haven't necessarily seen the capital investment that's required just yet, given that it may take 8 to 10 years for some of the supply to come online. So you could see markets that are very tight in the next 10 years. And there I will just round off with our price projections. We see palladium prices stabilizing and then starting to come off. Platinum, we think, will start to trend above $1,000 per ounce towards the end of this year on a more sustained basis. But thereafter, we expect platinum prices to start to trend higher over the next 2 to 3 years. In contrast to the complex as a whole, we think there's more upside risk for platinum than there is, say, for gold. So we think gold is the market where we're going to see markets starting to trend lower as the Fed starts to tighten, as some of that investment demand starts to ease, and we start to see the physical market setting the floor. So in the near term, platinum and palladium are likely to outperform, but in terms of the longer term, we expect platinum to be the metal that has the most upside risk. And I'd be happy to take any questions if there are any.
How do you model the rhodium price? I know it's a thin market,
Yeah.
but it is such a driver of the PGM producer baskets.
Right.
I mean, I think, like I follow Sabania, I think it's single digit in terms of their production, but upwards of more than a third of their revenue.
Right.
So how would you model it in that thin market?
Yeah. It's very difficult. I'd say so for the rhodium market in particular, we're looking at some of the shocks that we see on the demand side and what shocks we might see on the supply side. But whereas for the other markets, we do a balance that is bottom up and we overlay it with our macro outlook. For rhodium, I'd say it's slightly different. We're looking at it as a byproduct. We're looking at how tight the market could be. And in terms of the upside risk, I think that's slightly easier to determine, but the downside is being driven by the PGM basket. We know rhodium is a key component when we're looking at the 4 PGM baskets, and it really tends to set the floor in terms of whether production will be profitable or not. So we know roughly with, say, for instance, for platinum and palladium, where the low levels are, where prices could need to trade above for production to be profitable. But rhodium is the key swing factor. So I'd say out of the entire complex, it's the one that's the most challenging to forecast. So the one that has the most is the most variable and is the most volatile. So I'd say it's much easier to say where the pressure is, where the risks are, whether the risks are to the upside or downside, rather than being able to say this is where the ceiling is likely to be or this is where the floor is likely to be. It's much easier to be able to do that for the other metals than rhodium. So it's a challenging one.
Any other questions at all for Suki? There was a question that I had just around Chinese jewelry demand that was raised this morning. Do you track that in terms of platinum as well? And do you see that tailing off like someone commented this morning?
Yeah, I think jewelry demand was something that I think the market as a whole really focused more so on before COVID. And I think jewelry demand was really important for the platinum market because it set the floor for the market. We knew that when platinum dipped at lower levels, that's when we would start to see the jewelry market materialize, the consumption would be responsive, and it would provide the floor for the market in combination with the cost of production. But now we're seeing that even though the jewelry market makes up a huge share, with expectations of economic growth being a bit slower, especially in China, given how focused the jewelry market is concentrated there. We're not expecting a huge rebound when it comes to jewelry. But also we don't think it's going to be the key swing factor for the balances for this year, although it's still crucial in terms of providing the buffer. And I think this is one of the factors what makes platinum an attractive market, because it's quite diversified in terms of its end use. It's not just dependent on auto demand. It has the buffer from the jewelry side as well. Whereas palladium is very heavily dependent on palladium, so on the auto market, sorry. So we think it is important, but we're not expecting a significant rebound when it comes to jewelry for this year.
Okay, very good, very interesting. Unless there's any further questions. Okay, thanks very much, Suki.